Hello and welcome. I'm Tshepo Modiba and this is Buy Africa, where we focus on investment opportunities across the continent. Oil has been making financial headlines recently as it plummets down to levels we haven't seen since 2008-2009. Joining me now to look at the declining oil price and particularly its impact across Africa is Brian Dlamini from Afriwise Consult. Brian, 60%, nearly a 60% drop in the oil price. I think one of the estimates I've seen is that in terms of the value of it, it's $2 trillion less that oil producers have made since mid-2014. Quite a dramatic movement. Any thoughts in terms of what the likely prospects are for the oil price going forward? Because it's got a potentially big impact on the continent.
Yes. You're right, it's plummeted quite a bit. It's hurting about 5 key markets on the continent: Angola, Nigeria, Ghana, Libya, and Algeria. Those are the big ones.
Yeah.
And as far as looking forward, you know, what's in stock for these countries, there's basically 5 drivers of the oil price trends. The first one being the fact that the USA has been drilling. They're now importing less oil,
right,
even though there's a turnaround in terms of the economic situation. So they will import less. So therefore, the demand from these countries also plummets.
And to be fair, at some point, they actually may be oil sufficient. They may not even have to import oil at all.
Perhaps that's the case. I mean, but for the near term, that's the scenario there.
Sure.
The other reason is we've seen China recording its lowest growth number, 7.4% for 2014, according to the Financial Times just recently. The other scenario is that the IMF saying that global growth will slow down this year, revised downwards, mainly due to Europe, Japan, and then you've also got you know, your Russia also
slowing
playing
emerging market growth as well. Yep.
So that's the second scenario. So demand will go you know, down. The other issue that comes into the equation is the OPEC story, where clearly some countries are not going to compromise in terms of market share. They won't drop production. And when they don't drop production, they will definitely hold the prices, you know, to there's more, I call it, downside risk to it.
Sure.
Then you've got another factor in the equation which says expected demand, because the oil price is driven by 2 factors: actual demand and expected demand. Expected demand is going to go down. Why? Because oil companies are going to invest less now into, you know, production, into exploration and so on. Therefore, the markets will also, you know, expect the oil price to go down, and hence it will. And then there's obviously a very interesting 5th element which says the market has looked at geopolitical risk,
right,
and they've digested this concept and said, look, even when there's a, you know, a war or instability, production doesn't actually get affected. We've seen this in Libya. So these, you know, geopolitical shenanigans haven't driven the oil price fundamentally. It's been a bit of speculation behind it.
Right.
So all these factors don't, you know, when they come together, they don't indicate that we will definitely see the oil price running away to the upward side anytime soon.
So let's touch on the likely impact on the 5 markets that you've spoken about, Nigeria being the largest. What is the likely economic impact?
Well, for Nigeria, it's going to be quite significant. First of all, they've got a scenario where their cost of production is between $30 and $40 a barrel.
Right.
So
at these levels, they're profitable, but not coining it in.
Well, that means that the projects, basically the cost of producing the oil. Then you add on top of that capital costs for some of these for some of these investments.
Right.
And then you start going upwards. And then you add on the very murky way it works in Nigeria, including the fact that it's not a transparent market. Corruption goes into the sector, X, Y, and Z. And whatever factors, you getting a break-even price, I mean, according to analysts, of about 110
Oh, wow. Okay.
dollars a barrel. So clearly this is not a good scenario for them.
Yep.
So what does it mean for Nigeria? It means, well, the big oil companies will definitely put brakes on expansions. They'll definitely put brakes on, you know, going forward, let's call it exploring where else they can find cheaper ways of producing oil. Because, I mean, despite the fact that Nigerian oil is premium, I don't think that's a good enough reason for people to pump money into the sector when the scenario is like this.
Now, we know that oil has been, or the oil sector has been forming a smaller and smaller portion of the Nigerian economy. Does the pressures on that sector still mean a significant drop in terms of GDP growth?
No, absolutely. I mean, 80% of government revenues comes from oil, 95% of exports. So we're talking about something that will affect government, not indirectly, directly.
Yep.
Then the indirect, effects will be on the ancillary industries that are linked to the oil sector. Right. Now that's where the secondary, the knock-on effects will come through. And I suppose for now, I mean, I wouldn't be able to tell you what the multiplier effect would be, but there definitely will be a negative impact. Now, this is again another reminder for African countries to take a page out of, countries like Saudi Arabia and UAE to save when the oil price is high. When they can save, they should definitely tuck away for rainy days. The reason why countries like Saudi Arabia and the UAE are not so worried is because A, the cost of production is very low, $6, between $5 and $6 for the per barrel for Saudi Arabia. They've got 900 billion barrels of recoverable reserves.
Right.
On top of that, they've got a sovereign wealth fund that's worth billions. So they can weather the storm for the foreseeable future, in fact, for quite a long time. For Nigeria, I don't know what exact time frame, but it will start to get very, very touchy when we see pressure on their currency as well.
Okay. Now, one of the big themes from the last couple of years has been discoveries of new, not just oil, but also gas pockets. Tanzania, Mozambique, those have benefited quite nicely from that. What does this lower price and lower energy prices in general mean for those economies?
Yeah, the lucky thing with East Africa is that none of them are producing, say, oil right now. They're all importing. Rwanda, Uganda, Kenya, Tanzania. Right. Lower prices, lower inflation for them. We saw, I mean, during the Horn of Africa crisis, there was a spike in inflation, partly linked to droughts, but as well, oil imports also contribute. And this is a welcome development for those countries. Sure. Definitely for a country like Kenya, this is going to be very good. They're really in good shape in East Africa generally. So in that region, it's good for them. What it means from let's call it an investment perspective, it means that companies will invest, like I said, a little bit less in now exploration activities. And you might, not for now, but all the gas stories, people will rethink their investment strategies now, or their development plans, to see if they cannot, tweak things here or there. That's what it means. But I think overall, in the long run, it means that investors will now start to be much more cautious, because you want to hedge your bets. Eh?
Yeah. So, to summarize, the oil producers in the name of those 5 countries will be hurt quite substantially, and the oil consumers, East Africa being a big block in that, will benefit quite nicely. What does that mean? I mean, if it's only 5 countries that are really the dominant producers, does that mean, broadly speaking, actually a lower oil price is good for the continent?
A lower oil price is good for the oil importers, and a higher oil price is good for the ones that obviously produce oil. Sure. But I mean, having said that, there's a lot of countries that produce oil on the continent. The big ones will get hurt, I think, the most. The other countries have really, I mean, you look at a Gabon that's already put in place a strategy to diversify its economy away from oil, because they don't want to be caught in this type of storm. they see the risk of this. They have got a sovereign fund as well. So they kind of saw the dangers. For countries like Nigeria, where there's already question marks in legislation around the oil sector, they haven't saved, elections are coming, it isn't that nice of a picture, isn't it? So I think one should definitely look out for Nigeria. Angola is also going to be hurt. Lucky for Angola, in some ways, you know, there's a bit more transparency, so the ability to react quicker is there.
Which are the industries, the ancillary industries, I think we touched on a little bit, that are likely to be impacted by this retraction in spending that's likely to happen if the oil price remains at these levels? Which ones should investors be conscious of?
Well, you can imagine, I mean, the manufacturing industry, for one, that manufactures components that go into the sector. You've also got the services industry, broadly speaking, that will be affected. Banks will also be affected because, I mean, the money that flows in and out of these markets because of activity in the oil sector.
Because ultimately they provide funding for a lot of these activities.
Yes, they even trade, you know, Forex and other related products on behalf of, you know, the oil producing companies. So clearly it's going to touch a whole lot of sectors. The magnitude obviously will vary depending on which country you're in. So we would have to dig deeper and see what the numbers on the ground will look like. But the knock-on effects will definitely be quite significant, much more significant than, for instance, the mining sector, where, you know, direct taxes are not the case. I mean, here we're talking about a production sharing agreement where government will take out of every barrel a margin. And when that suddenly disappears, government can spend, government borrows more, the economy starts, you know, being in shaky condition, shaky shape. The currency is also going to see, you know, fire when there's depreciation. So, yeah, those are the factors that we must actually be looking out for.
Okay, let's leave it there, Brian. Thank you for that. A mixed picture, as we can see, the impact of oil across the continent. Thanks to my guest, Brian Dlamini from Afriwise Consult. That's all from Buy Africa this week. Remember to follow me on Twitter, that's @Modiba_Tshepo, and send us your thoughts about the show using the hashtag BuyAfrica. From me and the team, goodbye.